In this week's video, we'll cover secular stock market signals that have only occurred one other time since 1928. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off this week's video with some interesting long-term signals using DeMark counts. DeMark charts and indicators are proprietary tools from Market Studies, LLC. It's a daily chart of the S&P 500 that we're looking at. We're looking at calendar year 2003, where my cursor is. If you're not familiar with DeMark counts, a 9, which is over here, paired with a 13 tells you that the probability of this bullish trend being exhausted is higher, and in this case, the 13 was a good signal. We did get a reversal. It works in both directions. In this case, this 9 here is paired with this 13, indicating a high probability or higher probability of this trend being exhausted. And in this case as well, we did get a reversal after the 13. This line here is somewhat of a demarcation line. It tells us that this 13 is still in play as long as price stays below this line or we don't get what's known as a qualified break. Same thing here. This 913 remains in play as long as this line remains dotted. If we do get a qualified break, which is what happens here, this 9 and this 13, this is kind of the demarcation line here. When it turns solid, it tells us that this 9 and 13 has been negated because this trend is strong. So when we see this qualified break of this line here, it tells us that the trend is strong and it's probably going to continue in a bullish manner. And in this case, where my cursor is, we're in June of 2003, and that indeed was the case. So we can get good information either way, from a reversal or a qualified break. The concept of market fractals applies to DeMark counts, telling us that they can be useful on multiple time frames: 1-minute charts, 60-minute charts, daily charts, weekly charts, monthly charts, and even annual charts. So we're taking the same concepts to an annual chart. We have a 9 paired with a 13 here, telling us that we have potential trend exhaustion. We want two things to happen for this signal to stay in place. We want price to stay below the line for the most part. All things being equal, we'd prefer price not to exceed the line, but the more important one is we don't want the line to be a solid line as it is now. This 9 and 13 turned out to be a good signal. It was still in play in January of 2000. The S&P 500 then dropped 50%. This signal has been in place all the way until basically the present day. It recently has turned solid, negating this 9 and 13. There's two things that are happening over here in the present day. Again, this is an annual chart. My cursor is on January of 2013. This is January of 2016. There are two bullish developments on this chart. Number one, it's bullish when price can exceed this line here and close above it. And the second step is that it stays above it long enough to get what's known as a qualified break. And in January of 2016, we get a qualified breakout. This is DeMark's sequential count. When is the last time we saw something like this? Step 1 would be price exceeding the line. This 9 and this 13, the last time price exceeded the line was January of 1983, which was an excellent entry point for equities. How about the last time we got the qualified break of this line here, another potentially bullish signal? The last time that occurred was in January of 1997, and if you know your market history, you know the stock market rocketed higher from 1997 into the spring of 2000. The cross of the blue line by price was helpful in 1983. That was a good entry point. And the qualified breakout was helpful in January of 1997. We have both of them in the present day. DeMark has 4 primary counts. We've been looking at the sequential count. Now let's move to the combo count. Similar situation. In the present day, we cross the line in January of 2013, and we get the qualified break in January of 2016. When was the last time we got those 2 bullish signals? In this case, price closed above this blue line here for the first time in January of 1980, and obviously this is a good entry point from a long-term perspective for stocks. Stocks go from here to here. And maybe more importantly, we get the qualified breakout, which is what happened in January of this year. This line turns solid in January of 1982, which was an outstanding entry point. We have both of those signals in the present day. Just as they spoke to probabilities back in 1982, they speak to probabilities in the present day. Now let's switch from the combo count to the aggressive sequential count. Similar situation, price crosses in January of 2013. The line turns solid, negating this 9 and 13. 3 years later in January of 2016. When is the last time this happened historically using this DeMark count? Price closed above the line for the first time, most likely in January of 1982, and simultaneously, this became a qualified breakout. We have the same situation in the present day. Price is above the blue line, and we have a qualified breakout. Price is above the blue line, and we have a qualified breakout back in January of 1982, which was an outstanding entry point. Now we're looking at a weekly chart of the S&P 500. This is calendar year 2010. This is calendar year 2013. These are our 3, for illustrative purposes, only weekly moving averages, the 30 in blue, the 40 in red, and the 50 in green. We have our consolidation, then the bullish breakout, and what looks like, from a moving average perspective, harder markets are followed by easier markets. As we mentioned last week, it's never easy. It's helpful for us to understand how much volatility we would have had to withstand to be a buy and hold investor during this bullish period. We have a full bore bullish look from point A to point B. Now we're going to zero in on point A to point B. Again, if we're just looking at this weekly chart and the moving averages, this looks relatively easy. However, if we flip over to a daily chart and zoom in, this is January of 2013, this is March, you can see there were several pullbacks along the way, including a 3% drop. If we zoom in on March through June of 2013, we get several givebacks, including a 3.8% drop and a 7.53% drop. It looks easy to look at this on a chart, but if you're watching your account balance every day and watching your positions, we're expending a lot of emotional capital in here. Later in the year, this is June here, this is September, a 4.8% drop, a 1.35. Now we're looking at October through the end of the year, 4.85% and 2.54, and 2 smaller givebacks here. Therefore, what may have looked easy from a weekly moving average perspective really doesn't look that easy from a volatility perspective on the daily chart. In fact, in order to capture the 29.6% return from point A to point B, if we sum up all of these givebacks, we had to withstand 37.59% of givebacks. It's never easy. The market model uses moving averages to help us try to smooth out this emotional roller coaster. This is the 200-day moving average from point A to point B. And you can see it looks very solid, telling us that we have a very, very strong trend. If we pull price out of the equation, this does start to look relatively easy. And if we look at the 200-day moving average from point A to point B in isolation, you can see why our focus tends to be on trends instead of noisy and confusing price in isolation. This is a lot easier emotionally and a lot easier to use as a guidepost for management than this. The same concept applies to a weekly chart. If we remove price from the equation, point A, point B, 30, 40, and 50-week moving averages, this looks a lot easier than this, which brings us to a point that we will review over and over and over again. Jesse Livermore, it was never my thinking that made big money for me. It was always my sitting. Got that? My sitting tight. This helps us sit tight. It's a prudent and rational way to monitor and manage risk and reward relative to this emotional roller coaster, and we should always expect an emotional roller coaster. Markets are never easy, and if all the bullish signals that we've covered in recent weeks and months turn out to be followed by bullish outcomes, I can assure you there'll be plenty of volatility, and along the way, it won't feel like it's easy from an emotional perspective. In 2016, the S&P 500 has been consolidating and kind of moving sideways after a big run. What would it look like in the present day if we had some relatively mild pullbacks? And these are relatively mild pullbacks, the pullbacks that we saw in 2013. Now we're looking at a daily chart of the S&P 500 as of December 22nd at 1:30 p.m. Eastern Time. This is the little batch of consolidation that we just talked about. And these horizontal lines represent pullbacks that would be similar to the pullbacks that we just covered from calendar year 2013. Here are the percentage givebacks or pullbacks that we just covered in 2013. If we assume the S&P 500 pulled back from this recent peak here, which was 2277, we could drop all the way back to roughly 2100 if we saw a 7.53% drop, similar to the 7.53% drop that occurred in what appeared to be an easy calendar year, 2013. If price moved to any one of these lines, it really wouldn't be particularly alarming, most likely, from a trend perspective. We can port these same concepts to a weekly chart, and we can also use our weekly moving averages. We can see our 30, 40, and 50 week for illustrative purposes only MAs that we've covered numerous times on December 22nd still look healthy. This is a full bore bullish look. And if we remove volatile price, we can see all of the slopes are healthy. And right now, this still looks good from a long-term perspective. Pullbacks and givebacks and red days and multiple red days are always part of the equation, telling us that it's important to have the patience to stay with a winning position as long as that position is working, even if it means keeping a single position for years. This is a quote from the book Market Wizards. If our position was the S&P 500 and these lines were our criteria, this position, despite the recent volatility, is still working. Remember, we looked at the 200-day moving average in 2013. How does the 200-day look in 2016? As of December 22nd, it still looks healthy with a nice bullish slope. As we noted last week, another thing that's not particularly easy to capture a gain from A to B is the relatively even mix that tends to occur between green days and red days, even within the context of a bullish trend. This is calendar year 2013 here, and this is the rally into 2015. As human beings, when we see a bullish analysis and we see bullish signals, we're somewhat almost appalled when the stock market has the audacity to go down for one or several days. Again, staying too close to the markets and constantly reviewing intraday percentage changes in the value of our positions can expend a significant portion of valuable and limited resources in the form of mental capital, emotional stability, and the ability to remain focused and disciplined. Therefore, as long as these long-term signals remain in place, and they're still in place, we don't know how long they'll remain in place, but as long as they're in place, then we will respect them and focus on the longer term rather than what we know is going to be inevitable red days, inevitable givebacks. This is a whole month of givebacks here within the context of a bullish trend. Try to take our focus off of this and focus on the longer term trend. We've covered this before from Market Wizards, but it's very important. Investors tend to confuse short-term volatility with long-term risk. The longer the time period, the lower the risk of holding equities. People focus too much on the short term, week to week and month to month, and they don't pay enough attention to the long-term potential. This is a big move from A to B, and if your focus is on the longer-term trends, you have a much higher probability of capturing it than if our focus is on the day-to-day, week-to-week, and even month-to-month volatility. The typical investor and Wall Street in general, they tend to focus on short-term time frames. How do we do this week? How do we do this month? How do we do this quarter? And even how do we do this year? Remember last week we covered long-term setups. 2016 looks similar to 1994 and looks similar to 1982 in some ways. A quarterly return or even an annual return doesn't mean that much if you can participate in a multiple year bull run. We don't want to focus on the short-term potential. We want to focus on the long-term potential. How long? In this case, this rally lasted 5 years. There's a lot of frustration in here. And if you were running a trend following system, you most likely underperformed in here. However, if your focus was on the long-term potential and you executed properly, this doesn't look like much relative to the 6-year rally that followed the frustration. We've had an even longer term period of frustration here, and we're not forecasting anything. But what we have in front of us today, which may change tomorrow, but what we have in front of us today tells us it's within the realm of possibility that a multiple year run is coming in the stock market. And as long as we have these signals in play, our focus needs to be on the long-term potential rather than the short-term frustrations. How quickly can you make up some underperformance in these frustration boxes when you get a run like this? This is 1982, point A, point B in 1987. In this 5-year period, the S&P 500 gained over 200%. Point C is 1995 after the frustration in 1994. Point D is the spring of 2000. This is over a 200% gain. These types of moves put some underperformance in the short run into the proper perspective. We've seen what bank stocks can do and what SP high beta can do relative to the S&P 500. This type of frustration and underperformance can be made up relatively quickly if we continue to focus on the long-term potential. How is it even in the realm of possibility that something like this could happen? Well, first off, if you ask somebody in 1982, do you think the stock market's going to go up 200% in the next 5 years? They probably would have said absolutely, positively, no. Here's one possible answer to how could it happen. This is a quote from Bloomberg. We're going to simplify it a little bit. Economic changes under the Trump administration may be more significant than shifts from socialist to capitalist that occurred from 1979 to 1982, according to Bridgewater Associates. Comparing Trump to Margaret Thatcher and Ronald Reagan, the incoming administration may have a much bigger impact on the U.S. economy than can be measured by tax changes and fiscal spending, meaning if you put pen to paper, you might not be able to figure it out. The Trump era could ignite animal spirits and attract productive capital. There's no question the animal spirits have returned to the markets in a way that we have not seen in the last 2 to 3 years. We have no idea how long these bullish signals will remain in place, and regardless of what we've seen over the past 6 weeks or so, or the last 2 or 3 years, we will head into next week with a flexible, unbiased, and open mind, and we will be open to all outcomes, from wildly bullish to wildly bearish. We're just going to take it one day at a time. Right now, we know we are allocated properly relative to the facts that we have in hand. Tomorrow is a new day, and next week is a new week, and the following month will be a new month. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.